How long are buyers going to be forced to deal with elevated levels of interest rates? In this episode, we are talking to the number one BMO Mortgage Specialist, Mychal Ferrera, about what is going on with interest rates, why are they elevated, and on top of that, we're going to discuss the top 5 most asked questions when it comes to interest rates, including, question number 4 and question number 5 in this interview. You're definitely going to want to hang around to understand as we talk about, is there panic selling? Is there debt restructuring? What's going on with mortgage originations? Are we seeing new business, or are people going to hold out for the fall market? So in this episode, we're going to cover a whole lot of stuff here that you guys have been asking over the last couple of weeks. And before we get started, if you guys find this episode, or any of our episodes for that matter, of value, all we ask is that you share it with another cool and interesting person just like yourself. Anyhow, with that being said, Mychal, welcome back to the show.
Thanks for having me. Great to be back.
Yeah, so Dan's on vacation, so it's just you and me this time. But before we kind of get into these questions and start talking about interest rates and inflation, we did get news this morning that the inflation rate has gone up from 2.8% to 3.3%, a rise of 0.5%. I don't know if it was entirely news in that respect. The last sort of rate hike announcement, they did talk about this potentially happening. So, and when you look at the base effects of inflation, without a doubt, it could happen. And so I just want to touch on some of the CBC articles that came out, just because to add some context to our conversation. So, knowing that that's gone up, grocery prices are still up well over 8%. I did read in the fine print, though, that grapes have fallen by 40%. So there's at least that matters. However, at the end of the article, we did read that the cost of mortgages are up 30.6% year over year. So a pretty tremendous rise in the cost of mortgages. That's not news. But I think what people want to talk about, and Mychal, maybe you can start shedding some light on this, is that rates, for the last while now, at least the last 6 to 8 months, have been elevated. And everything that we're hearing about is that rates are likely going to stay elevated, especially when you take a look at what's happened now with inflation having risen again. Do you think the Bank of Canada is going to keep rates higher for longer, or do you think a rate cut's around the corner? What are you hearing in your neck of the woods?
Yeah, I mean the catchphrase of the last few months has been higher for longer, right? And I think Bank of Canada has to be very careful about how they go about cutting rates, because it's like, the demand hasn't decreased. In fact, it's massively increased. I mean, immigration is on the rise, and the minute that there is some softening in rates, I feel like there's going to be this avalanche of people just getting in the market. So, they're going to be very aware of that. And I think when we do see cuts, they're going to be slow. But, anything can change. And the one thing that, I've learned over the past year is that, everything we think we know, we don't. And we were told by Bank of Canada that rates would stay low until end of 2023, and now they're telling us that rates will stay high till middle of 2025. So, take everything with a grain of salt. Now, I do believe that we will see some rate cuts potentially towards the end of the year. It really just is going to depend on, how inflation and employment numbers roll in. But I think the logical assumption these days is, assume not much will happen till the middle or to the end of next year.
Yeah, I think I largely agree with that, just based on what I'm seeing. But, to speak to your population points and the demand side of things, it's funny because in our last episode, Dan asked me a question about whether supply would remain low forever in Vancouver, and what would cause a good price drop in order for that to take place. And I said that, we would need a tremendous amount of supply to come into the market all at once, because the moment that rates begin to drop, buyers are going to come off the sidelines, and they're going to come off in droves as the rates continue to get lower. So you're kind of dealt with this scenario, right? Do we pay with, do we get a mortgage now? Do we buy a place now, get the home we want, but we're paying a higher rate? Or do we compete with everyone when rates actually finally do drop, but we end up spending $100,000 more on the house than what they're asking for? So it's like the lesser of two evils. And I think that kind of is maybe a good segue into the next question that we've been asked, which is around affordability. So, in the States, and primarily in the States, we're hearing stories where banks are now offering 35-year, 40-year, 45-year, 50-year amortization schedules. Basically, the old adage, extend and defend, right? And are you seeing in the Canadian banking system and maybe BMO generally speaking, have they begun to extend amortization periods for customers, or is that something that they haven't looked at yet?
Officially, no. I mean, 30 years is still the max amortization that you're able to get. There's been rumors that I've heard from, multiple sources that, potentially we could be going up to 40. When and if that will happen is really anyone's guess. Now, when it comes to existing variable mortgages, a lot of them have been extended past 50 years, right? Because when you're looking at a static payment, all you're doing is increasing the interest cost and therefore pushing the amortization out. So, pretty much any bank that has a static variable mortgage, their amortizations are probably already north of 50 years if they did it in the last year or year and a half.
Wow.
So, in some ways, yes, that's already happening. But officially, if you were to get a mortgage today, you could not go to 40 years. So, yeah, I think that there will be a change. I think it's, inevitable when you have high interest rates, high prices. It's kind of how will people qualify? I mean, most people are qualifying at 8-9% these days, right?
Wow.
So, $100,000 gets you like 420,000 mortgage. Like, what are you going to buy for that, right? So I think it will have an impact at some point, but so far it's just been rumors.
That's really interesting because when you consider, debt servicing right now, that's probably something that's changed a lot for you in your world. One of the questions that we saw on our YouTube channel was that, most people use somewhere between 28 and 30%. Financial planners actually recommend 28 to 30% of your income be used towards home ownership, the cost of home ownership. But seeing how rates have exploded and the cost of home ownership has driven north by a tremendous amount, what are you typically seeing? Like, what is the bank allowing when it comes to your debt service?
Well, so you got to remember that whenever we're talking about debt servicing, we're looking at gross income, right? So that's before taxes. The higher end threshold is 49% of your gross income can go towards total debt, including stress tested mortgage. Okay. So if you have a car loan, that goes towards it. If, taxes on the home, heating costs, strata fees, and then of course the stress tested mortgage. So 49% of it is the max. Now, if you're looking at just housing cost, which is the mortgage and like heat, taxes and strata fees, you'd be looking at 45% as the upper threshold. Now, when financial planners say, 20 to 30%, maybe in other parts of Canada, but when you're talking about BC and Ontario and, parts of Quebec, I mean, it really just depends where. I believe that numbers, when you talk about net income, I mean, we're paying minimum between 30 to 40% in taxes, it seems.
That's right.
So, you're actually paying about, upwards of 70% of your total income towards just keeping the roof above your head.
That's the real number, right? Because it's one thing for it to be gross income. After all your expenses and you're living your life, what are you left with to pay for your home, right? And that's the real number. So to hear that is kind of scary, So with that being said, then, if we talk about rates, and I know everyone's looking for a lower interest rate right now. So when you're looking at, if you are a home buyer, you've had a baby, you can't wait for the Bank of Canada at this point. What's the strategy now? A couple questions, twofold question. Are you looking at a fixed versus a variable rate? And if so, what's the strategy around using one or the other?
So It depends what side of the fence you are with that. I have this conversation with every single client who is looking at getting a mortgage, and there's two options. Do you want to know how much you're going to pay for the foreseeable future without any risk, right? And we have been pretty much recommending a 3-year fixed for that.
Hmm.
And the nice thing about our terms at Bank of Montreal is that you can early renew them 6 months before maturity with no penalty.
Hmm.
So if you're looking at a 3-year, it's really a 2.5 year. And
Hmm.
then when you think about what Bank of Canada is saying and where rates potentially could go over the next 2 years, that kind of lines up with when rates come down, right?
Yeah.
But
Yeah.
if you think that, Bank of Canada has done it again and they've overcorrected and they're going to have to start cutting pretty aggressively, then you take the risk and you take a variable, but you pay a premium. So, when you're looking at variables, you're looking upwards of 7%, whereas you're
Oof.
looking at fixed, you're on the low sixes. So you're paying almost a 1% premium to take that higher risk. And you're also assuming that Bank of Canada is going to cut more than 1% in the next year or 18 months for you to somewhat break even on that.
Hmm.
So, it really just depends on where you're at and what your risk tolerance is. Based on what we've seen, I think most people are leaning on the short-term fixed side.
Hmm. I could see that, especially with today's volatility. It's so interesting though,
Hmm.
because if you back up 2 years, when prices were jumping like crazy, variable was definitely the play because you could get more money to buy that
Hmm.
home, and in a
Hmm.
price environment, then that makes a lot of sense. But it's interesting on the going the other way now, variable almost doesn't make any sense. Getting a 2 or 3 year fixed mortgage right now is probably your best bet, right?
Hmm.
Um,
With the variable, like traditionally speaking, it's always been at a discount, right?
mhm.
You've paid less for the variable in order to take that risk. And during the period of time when the variable was 1% or more cheaper than a fixed rate, we would do calculations and say, okay, well, even if Bank of Canada increases 1.5% in the next, like these were the things that we were preparing for in order
Mhm.
to, really paint a picture. So when you have something unprecedented like what Bank of Canada has done, especially when they tell you that they're not going to do something and they do the complete opposite, it really jades everybody. So now everyone's more or less scared of variable, which I think people, if you're not willing to take a risk, you shouldn't take variable.
Mhm.
You want to know what you're paying every month, no matter what, then you go fixed. So.
Hmm. Okay, good advice. So, a couple other questions. Looking at trigger rates. Trigger rates were a
Mhm.
thing that nobody knew anything about a year and a half ago, and now I feel everybody knows what trigger rates are.
Mhm.
And
Yeah.
a lot of people, when they get that call from the bank, they've either been, I would say, and maybe correct me if I'm wrong, fewer instances have been mandated to increase. Most are being asked to increase,
Yeah.
and increase your payments so that you don't have to have a lump sum payment at the time of renewal.
Mhm.
So I guess the question I have, and what a lot of people are asking, I think a lot of what people are predicting, is that people will not be able to renew their mortgages.
Mhm.
And as a result of those trigger rates, they're going to be forced to sell, or they're going to foreclose. And then there's going to be this dump of inventory that hits the market.
Mhm. Mhm.
Do you think that's going to be the case, or are you seeing people finding ways to pay their mortgage?
Um, so it really depends on your individual situation. Now, if I have, and anybody with a variable is getting these calls, your amortization's over, you need to do something. And these calls can be quite alarming. I mean, they're basically painting an extremely grim picture. But
Mm-hmm.
the one piece of advice I can tell people is that this is a picture in time right now. Some people have 3 or 4 years left on their variable terms. What happens when rates start coming down, right? And this will start to go back the other way. So if you have an investment property and maybe you're a little bit tight, maybe I don't necessarily do anything. Maybe I just kind of leave it the way it is, right? But then if it's your principal residence, it's your home, then maybe you try to make some sort of progress with that, increase your payment to some
Mm-hmm.
degree within your budget. Do something. Don't do nothing is usually what I tell people. And if you don't want your payment to increase, do lump sum. But I think it's important to chip away at it to some regard. But, I think that it really depends on what that property means to you, what your individual budgetary, limits are.
Mm-hmm.
And I think a lot of people are pushing themselves to do things that maybe are extremely uncomfortable when in fact they don't really need to, right?
Mm.
A lot of the times it's an ask, not a tell. Um, and when it comes to renewals, now that's an interesting point, which I can see a mile away.
Mm.
And when I think we're going to see, before people are going to sell their places, before people are going to foreclose, they're going to try to restructure the debt. So
Mm.
what's going to happen? You get all these people whose amortizations are blown up. If we get to the point where rates maybe haven't come down fast enough for these people, they probably cannot renew with the same institution, because if
Mm.
they renew, they have to catch up all those missed years at once, right, for
Mm.
their next term. But if they go and I say, you know what, I'm just going to refinance either with the same or a different institution, you can restructure it, stretch it back out to 30, or maybe at that point, if there is a 40-year, and then you can reduce your payment. So I think we're going to see a ton of that happen in the next 2 or 3 years.
That's actually some really good advice. That's
Hmm.
another way of dealing with, like you said, this moment in time. This is a picture in a moment in time, right? Like
Hmm.
I look at, the home I live in, for example. If I choose to live in it for the next 20 to 30 years,
Hmm.
well, this is two to 3 years out of that cost of ownership that I've had to deal with an expensive part of it. Whereas, if I really balance that over the cost of, or over the, over a 20-year timetable, it's something that will blend out. I think
Hmm.
quite well.
Hmm.
We'll see. We'll see. Time will tell. But like
Hmm.
you said, I think it's really smart knowing where you can take that debt restructuring if your current
Hmm.
institution isn't giving you what you need, right?
Hmm.
Um,
One more quick note on
yeah.
the variable. A lot of people have a very, very high discount on the variable. So what we're seeing with most variables that I'm looking at now, they're in the low sixes, and fixed rates are actually in the low sixes.
Hmm.
So if you're one of those people that you're sitting somewhere between 6.2 and lower in a variable, it's probably not a great idea to turn that into a fixed rate, just because
Hmm.
you've kind of got all the way to the top of this rate mountain, and you kind of want to ride it down too. And when they do start cutting, your discount's so steep that your rate will come down faster versus being in a fixed rate at 6.2% for the next 3 or 4 or 5 years.
Hmm. Interesting.
So.
Okay.
Mhm.
So let's talk about the last question here. New business, effectively the fall market. Do you think, number one, that we'll see a rate hike in September, or do you think they're going to hold? We always make a prediction on here. Dan's been wrong the last like 5 times, and I've somehow been right, which was more just seeing which way the wind's blowing.
Yeah. Yeah.
uh, so there's no real saying at this point. It's all speculation. But based on what you do know, based on what you are seeing, where do you think rates are going to go? And then, can you speak a little bit to the mortgage originations? Are you seeing new business
Yeah.
come through the door, or is it mostly refis at this point? Because I'm interested to know.
Hmm.
I think a lot of people who might have planned to buy a home in the fall market are going to be interested to know if
Hmm.
they're going to be dealing with a lot of competition, or are people going to stave off, or
Hmm.
sellers going to hold. What's your
Yeah.
perspective?
Well, I've done more pre-approvals in the last year and a half than, I swear I've done in the last 7 years. So, these are people that have not converted. But a lot of people that have and are actively in the market right now have rate holds in the high fours, and they're seeing an opportunity. Well, it makes more sense for me to buy pretty much anything right now that I can get into at 4.89 or 4.79%
Mm-hmm.
versus waiting till my rate expires in October and paying 6 point something percent, because I can promise you from today till October, we're not going to see a justifiable decrease in values.
Mm-hmm.
So what you're going to be doing is paying more,
Mm-hmm.
right? And I think everyone's scrambling right now to try and get in. And I've in the last week, I've seen about 4 pre-approvals convert, because they're just like, we're going to find something. We want to save, tens of thousands of dollars in interest. So even if we pay a little bit more, it's still going to
Mm-hmm.
save us money
Right.
versus waiting. Or on the flip side, you get the people that, well, we're just going to wait, right? So, and if there's one thing that we've learned with real estate, especially in Vancouver and parts of Toronto, is that waiting doesn't usually go well. So,
Yeah, no, I agree with that. Most advice I give people is to buy the real estate and then wait.
mhm,
Not the other way around. It's largely because it's unpredictable, but at the end of the day, when you look at the fundamentals in our economy, with the amount of people coming here and them all flowing to urbanization, and the amount of infrastructure going into those urban spaces, they're preparing for higher and higher levels of density. So
mhm.
I tend to agree with you. So, Mychal, you didn't give me a prediction though. Are you?
Yeah. So, honestly, like my gut tells me that they will be holding. I think they're already starting to see the oopsie around the corner.
Mhm.
So, I think that they're gonna hang tight. Now, if inflation goes up after that, things might change, but I think for now they're done. That's my
I'm gonna
prediction.
I'm gonna make another prediction, and this is based not on fundamentals. This is based on psychology, because the last time they said they were going to hold, and they did,
Yeah.
everyone went out and bought a bunch of stuff and increased the inflation rate, and then they had to come back and slap it down again. And I think they're going to want to see even frostier climates before they release. I could be wrong, but I again, when we look at the history of the Bank of Canada, they said they would keep rates low until the end of 2023. Now they're saying they're going to keep rates elevated to 2025. I don't know if they know what's best at this point. We'll see. But if they do raise, I
Yeah.
don't think it'll be more than a quarter point. With
Yeah.
that said, I think it's more of a psychological move at this point. So I think we'll
Hmm.
see. But I'll have you back on in a month from now, and we can chat about who was right and who was wrong and which way the wind was blowing that day.
I absolutely would love that.
Anyways, guys, this is probably a great place to wrap it. Mychal, thank you so much for joining us today and for providing some guidance for people who are looking to buy a home. If you guys have any questions about your financing, Mychal, what's the best way that they can get in touch with you?
Yeah, so you can reach me by email, phone, or find me on Instagram and send me a message, and I'd be more than happy to talk about your situation.
Awesome. So we'll include that in the links below, as well as the YouTube channel. So hopefully, guys, if you enjoyed this, please share it with a friend. Otherwise, we will see you next week.